doing my job if I didn't point out that we're now just about a month out from the University of Virginia Investing Conference here at Darden, where we're lucky to have Dick back on stage November 10th and 11th. If you're dialed in, then you already know Dick's bio, and I won't belabor it. A 1964 graduate of the university and 68 graduate of the Darden School. Dick has founded 3 investment firms and been investing actively for more than 4 decades.
Someday I'm going to learn it.
And what you may not know about Dick is that we're lucky that he's become increasingly involved in the Darden classroom. There's, of course, the eponymous Mayo Center for Asset Management that bears his name, and there are also academic roles that Dick has taken on in an adjunct capacity, leading a financial history seminar with Dean Emeritus Bob Bruner. And Dick's been very involved in both the Mayo Center's new investing courses and an independent study with 2 Darden Capital Management students on stock buybacks, a topic which might come up this morning. As he says, we're soon going to have to put him on the payroll. I'm fairly sure this is also Dick's first webinar, so we appreciate your taking the time. Really quickly on the procedural front, you'll notice on your screen the chat feature. You can use this tool to type in questions during the webinar. You can send in a question at any time, so feel free to do so. You don't need to wait until the end. We'll go until about 8:30 or 8:45 and hopefully work in a few questions. So without further ado, Dick Mayo. Thank you, Dick.
Thank you. I enjoy this opportunity. I always love to talk about investing in the environment, and I think now is an extremely appropriate time to be discussing where we are. And so I want to take you through a series of charts. This is, I think, what you should be thinking about at this juncture and how we should be trying to construct portfolios. I'm always a believer that one of the most important things that we do in our business is, yeah, we accumulate information and analyze, but also how we think is quite important. This first chart, I think, sort of sums up the situation that we're in. Some people have said that's me trying to get across that canyon. But the point here is, it is an extremely uncertain, I think, possibly fragile environment, but we live in a low return world. And somehow or another, we have to keep struggling to get a return. Now, you might say, okay, it's getting too difficult or whatever. Maybe I shouldn't do that. But look at institutions around the world. They have to get a return. So it's harder. So next page. To me, at this point in time, are you clicking for me?
We're clicking. We'll get it down.
Okay, anyway, the next thing that comes up is what I want to talk about today. Where are we? The next page is more of a headline, and the headline is it a transition or is it a regime change? And I think this is the most important thing to be thinking about today, because I want to go through some things, and if you're observing every day, some things are happening that are somewhat different from the last few years. The important thing, let's understand where we are and how we got here. You'll be seeing going forward some charts from Strategas, which is a very good thinking firm on Wall Street. You'll see some from Empirical Research, who's one of the best quantitative analysts that I'm privileged to know, and there'll be some others which I borrowed, and it's helpful to the thinking process. Here, this is where this market is today. It's, however you want to measure, it's the 3rd or 4th biggest bull market in history. Look, I'm somebody that is somewhat risk averse or whatever. When you get in those conditions, you should be thinking about, can we stay here, can we continue, or is something changing? That's really the focus today. The next page is just for fun. I don't like the terms bull market and bear market, because they're not objective terms, so I think they affect your thinking. This was done by Jim Paulson, who's at Wells Fargo. I think it's Wells Fargo. And he said, this is a bunny market. It jumps around all over the place, winds up in the same point. So the question, can we stay in the same point? Now, how did we get here? That's important because each one of these things is possibly changing. And that's what you, me, anybody trying to manage money should be thinking about now. We got here because the extremely accommodative position of central banks. If you look at this, here are the combined balance sheets of the Bank of England, the ECB, Japan, United States. They are the ones that were a principal cause in this significant increase in asset values. There's also one point on that chart too. You can see there are a couple of periods of time where the bank balance sheet has paused. If you go back and look, you will find that there has been a great correlation between stock market movements and the central bank. And during those pauses, you either had a pause in equity markets, or we had 2 or 3 times in the last 5 years where you had a growth scare, and the market reacted to that. So I would argue we're dependent on that going forward. The next page. There's one other thing that has happened in this cycle, and it's somewhat unique. You went too far. I want the margins. The message of this chart, I'll come back and refer to that downtrend later. But the message of this chart is we have gone into record profitability in this cycle. That has helped drive the market and its values. I think it's important also to understand what has been happening. I would argue, and I spent a lot of time trying to talk to CEOs and whatever, this is a cycle where the focus of a CEO became obsessive totally about profitability. That's how we got to peak margins. It wasn't growth, it was profitability. And that is an enduring thing. It is still there. You can see it in CapEx spending, the most anemic in the past 4 or 5 cycles. So this is important because we need to stay here in terms of profitability. The market went to new highs. If you look at the last 14 months, that is all due to PE expansion. But with that profitability, they have been extremely productive in terms of generating free cash flow. These are the margins that have been achieved. That has helped the valuation process, but it has helped also one other change in thinking. More and more people have been thinking about equities as some form of bond substitute. Or they've been thinking about, when we took interest rates down to the 10-year 150 basis points, how can I get a return? Well, if you look at equities, you've been able to get a free cash flow return of anywhere from 4 to 7% over the last 2 or 3 years. So why not migrate in that direction? The point here is we need to stay here in this category. Here's the result. If you look at what has worked in the marketplace, you can see these have been the drivers. So is it important going forward? Can this persist? I think it can persist, but in a smaller group of companies, which is another thing that one needs to think about in terms of how you invest today. Here's one more example. Why would you consider equities in a allocation process? Because you can see bonds, equities are competitive with bonds, and it looks like that may be the case for some time going forward. How have people adjusted? How have they changed? One of the fastest growing funds in the business these days has been the dividend fund at Vanguard. $3 billion increase in assets in the last 6 years. That may not sound dramatic, but extrapolate that across the investment landscape. The money was rushing in so rapidly, they had to close the fund. If nothing changed, I would say this condition would remain the same. But what I get to next is possibly something is changing. The other thing, this chart may not look great, but I discovered it on a plane going to Boston and then coming back. And when you look at that, there are 2 dramatic numbers in there. If you look down at the bottom, you see the money that has flowed into real estate funds you see the money that has flowed into utility funds. It dwarfs anything else on that, on that page. There have been flows of money out in other places, but once again, the dominance of dividend or dominance of dividend growth has been a key factor of this market for the last 2 years. This is important from this standpoint. Something changed. Real estate funds are down 7% in the last 7 days. Something we have to understand and reflect. The next page is, it has been worthwhile doing this. Just look at the black line. The black line tells you the outperformance of dividends, dividend growth, etc. Might it be changing, is my question. And now just one more chart. This is something that's hard to, you could spend some 5 minutes trying to understand this. Just keep it simple. If we take the dividend sector of the market, if we take the dividend growth sector of the market, we take anything that has been associated with a movement of money into dividends. What this chart says, just look up at the left. These kinds of companies are now valued the highest in history. That's what that means. They're in the top 1 percentile of valuation. Can they stay there? It's not a bet I want to make. So let's go fast forward. We don't need to spend any time. If you took the market, as you see defined down below, this is what the market has done. Okay, we'll keep going. This is how you divide the market. This is how people have been investing portfolios. When you see something like that, I would argue you should rethink, can that continue? On the next page here too. There's one other thing about the market, which I'll come back to later. When people are referring to the FANGs, that's the Amazons, the Googles. Netflix used to be there, but they've been kicked out, and Facebook. But the point here is that people have said one of the ways I can invest comfortably in this market is the major growth companies. I'll come back to that later. I totally support that view. In a world where growth is precious, why not be here? Now, I'm beginning to talk about how things may be changing and how one should be rethinking what you're doing and investing in your portfolio. This is a chart done by Don Rissmiller. Just so I spent the weekend with about 25 investors in Bermuda, a discussion about the world. We had people talking to us like Robert Gordon, who wrote the book, Low Growth is Permanent. And so some of my thoughts are coming from that. I would say the majority of people there are nervous, hesitant, but still acting the way they've been acting for the last 2 years. Re-examine that point. Here's a chart. Remember the chart earlier where I said this market had been driven by central banks and profitability? If you look at this chart very carefully, what you can see and what Don Rissmiller would argue, like 2% GDP growth will not support the profitability you need going forward. Simply, that's the message. Think about it. I think all the intelligent people I talk to are now beginning to question whether you can be above 2. And just remember, the Federal Reserve in the last statement took their growth expectations down to 1.9. A struggle. Okay, next page. Simply what this is this explains the market for the last 14 months. First, the market stalled. It had some fluctuations because earnings expectations were coming down. The market has recovered because the expectations were worse than actual. Earnings were still negative, but they were an improvement over expectations. Now that 123 number is a forecast for 2017. Just a reminder that the next year's expectations are always much higher than actual. So that's not a number to bet on, but the point here is you can see when profitability struggles, the market might struggle. This chart has a lot on it. Here's something for you to look at and think about, but the upper left-hand chart is saying the same thing I just said. Earnings were beating expectations, and so it was a positive boost for the market in the short term. Now let's go to the next phase, and this is much more about valuation. A lot of people are saying the market's overvalued. There's a series of ways you can look at this. This is a chart I grabbed from the weekend. This was given to me by Keith Banks, who's the president of U.S. Trust, and they look at this and say the market's extended, but is it dramatically overvalued? Maybe, maybe not. Other assumptions determine that. Okay, I'm going to spend some time on this chart. There's a lot here. Just so you know, I encourage my people to have a few cartoons in here, because this is a world where you can get too pessimistic, too optimistic. So some of the cartoons will sort of mute these emotions. But here's the chart you will see most quoted. It's a Shiller chart, Robert Shiller, and basically, what his is, he's taking a 10-year average growth rate, extrapolated going forward, and on that basis, the market sells at 26 times earnings. Therefore, that's elevated, that's risky, whatever. On one measure, I agree with that completely. The other part here, and which I would like for you to think about, this is looking at things in a conventional way. And what I would argue, we are in an unconventional environment. If you just did a straight theoretical valuation analysis, yes, you get the market overvalued. But if you then superimpose on this in a world that struggles for growth, that will be the dominant force in the market. But it does not mean it is impossible to make money in the market. And this is what I'm referring to. Later, I'm just going to make a comment about Google. On that chart, you will see something. And this is the way I try to think now and then. If you're struggling for a return, everybody's struggling for a return. If you took the 10-year bond today, it could be changing pretty quickly. I don't know. The unemployment number is coming out. Who knows what happens? It's not going to be unvolatile. But if you're trying to get a stream of earnings, that 10-year stream of earnings, you are essentially paying 57.8 times earnings for that. If I can get a company that grows, or if I can get a company that grows at double digits, and that comes back to the Google type of stocks, I'm only paying 23 times earnings. So why don't I make some investments like that? That's no statement about the market, but it's just a statement about where I can still get a return in the market. That's a huge differentiation in value. And just so how I think about this, I'm a value investor. George was nice enough to say, you've been a value investor a long time. But I would rephrase this. This is value. When I can get a discount from something that should be selling dramatically higher, that's a value. Just the bottom of the chart, that's sort of a reflection of all the central banks are struggling, don't seem to be successful stimulating the economy, so it's highly probable interest rates stay low for a long period of time. The next page, I'll go through this pretty quickly. This comes from Jason Trennett, who I was also with this weekend. He's a very good investment thinker. So he was putting up there, this is his view of what's going to happen over the next couple of years. There are a series of scenarios, and he was sort of, oh, the market's okay. And I said, hey, Jason, if you look at it another way, your scenarios here are, the best I can get is 8%. The worst I can get is down 28%. Those are odds I don't like. So that makes me more careful, more cautious, etc. Now here comes to the point about today that we really have to think about. We have been totally dependent on the central banks and corporations earning profitability. A conversation has started. It was under the surface, but now it is full-blown front-page information. The central banks are beginning to have to recognize that their monetary policy is not delivering the results hoped for. You first saw that in Japan when they said, let us pause before we do the next monetary policy analysis. You've seen it more recently when Mr. Draghi said, we're not going to tell you in September what we're going to do in March when the QE is supposed to expire. We will wait till we get there. Okay, some self-doubt. And just that bottom chart that you see, big headline, front page, central banks' tools losing their edge. It's important for me to reflect on these things because if one is generating some doubt, I think that will be reflected in the marketplace. It's reflected in how I think, and I think we're now at a stage we could be sort of, let's think of as interim. The general consensus today seems to be we can't totally depend on the central banks. It has to be some form of fiscal policy to stimulate growth. It's a fine thought. I have no disagreement with it. Somebody I thought said it very effectively. We have now entered a period of time where we'll probably be pivoting from monetary policy to fiscal policy. Remember, that doesn't happen overnight. Its impact can only be a couple years out. So we're still dependent on results for the next year or two. The important thing, and this is where I step back, is something is changing. Think about it, look at it. Look at the sharp increase in interest rates over the last 30 days, 20 days. To me, this is a reflection of the marketplace is saying, I'm beginning to rethink what central bank policy can create. Now remember how we got to this, how we got to a new high in the stock market was very simple. You had Brexit in England. There had been some risk aversion before that. People had taken money off the table. The vote was to leave the EU. The immediate response was, okay, this is not something that hurts me tomorrow or this year. And the British Central Bank reduced rates immediately and said, we will keep supplying funds. So their interest rates tumbled. And what has happened consistently in this world, when European rates tumble, money flows into the United States because that's where the highest yield is. A similar thing has happened in Japan. When Japanese rates went negative, money flowed into the United States because that's where you could get a positive return. If there's a rethinking process, this process may be under change. So that, to me, is the principal risk in today's market. I also have some doubts about profitability, but then we come to the next stage. I'm not going to spend any time thinking about this. The whole point here is we have an election where something will change. You know, the anger is a new policy. Why is that? Because we have the United States, there's been a dependence on, let's call it 3% growth to satisfy a broader section of the population. It's not happening. And just one last thing here, I won't spend any time on it. This is a chart very simply. Okay, we don't, just for the thinking process. Okay, something's going to change. We will have a different administration. That's a little bit of an uncertainty. But the point is, if you want to have probabilities, somebody's constructed a probability on this chart. If you look at the chart, what you see is, I think 87% of the time, when the stock market is okay, the incumbent wins. We don't have an incumbent, but we have an extension of the previous administration. But one last point here, the degree of uncertainty. The Republican side is an uncertainty because we're not sure what policies will be. The Democratic side will be uncertainties also, and it's more from this point. The fellow has constructed this kind of work, and these last three charts, Dan Clifton at Strategas. He's a great thinker, and several conversations I've had with him. Remember, Dick, in Washington, personnel is policy. The people that get into the administration will have a significant influence on policy. He knows the people being considered, he knows the people that's being evaluated, and they will be people that are in favor of significant change. Okay, now let me get into the next stage here. We got to go to a stage, we can't we can't totally focus on the negatives. We have to make a return. The world is desperate for a return. This is just a comment on that. Okay, a low rate world. Okay, we can't have a dramatic increase in interest rates. For the moment, I'm going to say it's a transition, a fluctuation. But the next page here, since I'm from Boston, I get to pick on Harvard. But here's a statement, I think, which every institution in the United States is thinking about. Harvard got a negative return. The endowment return for June to June was negative 1.2. I'm pleased to see University of Virginia, which was reported at negative 1.2. When you adjust for private equity, it was on the plus side. But the point here, that last chart, they're having a strike. The statement is their costs are going up. They need something to fund increased costs, and how you get it in a low return world. And so now we come back to, I started to label this chart. This is why equities, I think, are now somewhat of a preferred asset. I referred to Jason Trennant. He was the author of the term you may have heard, TINA. What does TINA mean? TINA means there is no alternative. There's no place I can find where I can get a return. When in the world, $12 trillion of bonds have a negative yield, that's a limitation. So where do I go? It's back to what I'm talking about. Corporations have cash flow. I have to get that. And one thing that is truly different about this cycle versus the previous 20 to 25 years, the majority, it's probably now almost all corporate officials, all CEOs have a great willingness to return cash flow to shareholders. You know, having cash flow, it's a nice theoretical concept. It doesn't help me if I don't get it. The number one thought process for corporations today is returning cash flow. So I'm going to stick with this. Equities still have a value. The key point here, there will be fewer companies that deliver that. That's the point. Now, just quickly, running through some items. This has been one of the most distrusted rallies in history, I would argue. Look, it wasn't a flow of money from institutions, pension funds, or whatever. The biggest buyer of this market, look at the upper hand chart, is the corporation, the repurchase of stock. And up there you can see almost no growth in capital expenditures. I think that will continue. Not at the same pace, but if you look at the next page, you will see, okay, I do have an offset to them slowing down. Just simply, it's M&A. You find more and more companies making acquisitions. There's a willingness to make acquisitions. I talked to a CEO and I said, why did you buy that? Why would you not buy it when I can finance it at 1.2%? That's the mentality going forward. So there is a bid in the marketplace for some equities. The next page, just real quickly, there's that, but here's back to the skepticism about the market. As you see, you look at the flows of funds. People have been willing to pull out of the U.S. market for the last 2 years. For a while, the money went to Europe. For a while, it went to Japan. And I think, given the profitability here, how do I explain the market over the last 3 to 5 months? Some of that money is coming back. It will continue. Just look over the upper chart. The total of this bull market, equities by institutions, is negative. They have sold. They probably are thinking about readjusting. Now, just quickly, I want to mention a few things. This is my most important thinking process at the moment. I have to try to get a return. The world is uncertain. If you're an intelligent person, you would say, in this world of uncertainty, which is rising, I'm foolish if I think I can forecast everything. So the most important thing to me, as this statement says, first, defense. And if I have my portfolio adequately protected, then periodically I can be opportunistic. So just quickly, just a few things I want to say. I have 2 or 3 things here. I'm not trying to argue you have to buy this stock or that stock. The important thing here, find those companies that have an ability at this juncture to improve themselves. United Airlines has been a mismanaged company for the last decade. They've been trying to improve. I'm also a believer you should be thinking about the airline industry because maybe they have more pricing power than everybody gives them credit for. When there are 4 airlines that have 80% of the capacity. Periodically, the capacity may increase a little bit too much, but as you've seen over the last 3 months, once they saw that was a negative, they pulled it back. There's one other thing here. Go look for these sorts of things. I have succeeded in my career by doing one thing in particular, and that is look at an industry when all the top CEOs have been changed. That wasn't my original idea. It came from somebody I won't name in the airline industry. It says, it's one thing you can count on going forward. The people that are now in management will not make the same mistakes as the previous managers. They will not overexpand. So look for companies that have control of their own destiny. It may be improvements in margins, as you can see here. It may be some pricing power going forward, or it may be some other thing. But let me also say, before I get to as far as this is something about Google. I don't need to spend any time on it. I think the numbers sell itself. If you can find 10 Googles, invest. If you can't, don't. But there's one other thing, let me come back and redefine. I said there will be fewer companies that can deliver a return. Remember real estate flows, remember utility flows. One other flow is the consumer staples. I can now go say, I'm seeing a profit erosion in REITs. I'm beginning to see some peaking of utility earnings. Consumer staples, I can see growth rates of revenues coming down. And let me throw in there healthcare, which is now having some doubt because I'm not sure about the numbers, but somebody has said a third to half of the growth rate has come from price increases, which I think will be gradually taken away from it. If you add that up, I just defined 30% of the market. So 30% of the market, I think, has to struggle. Therefore, go look for things like this. I'm a value investor. This is my biggest position. I'm never saying that because I just set myself up to get. Now, one last thing, and then maybe there's some questions here. I referred to, in this world, you need to think unconventionally and whatever. One of the debates has been ongoing. I had it this weekend. Is what is a safe haven? If the tailwind from the central banks is possibly shifting, are bonds a safe haven? Not sure. Look at the volatility of the last 10 days. Are safe stocks a safe haven? I just said, if you go back to that chart, Michael Goldstein selling at the highest level ever, they're not safe havens. Historically, we've said treasury bonds are safe havens. Look at the volatility there. So I can just go through and say, we don't know what a safe haven is. I throw up gold as a thought process in this regard. If you can't protect yourself in currencies, and if you can't be relaxed in currencies, look this morning. The British pound is down 6%. In history, that is a dramatic move. So there's some place I need to hide. The people in London that bought gold are comfortable. The people in Europe that have bought gold over time are comfortable. The people in China are comfortable because they have no mechanism to get their money out of the country given the constraints of the government. And if you look at the papers this morning, you will see that the reserves of China shrunk more than expected. So there's a consensus here that I've had a series of people. Maybe gold is a safe haven. Maybe it's an inflation protection. I'm in the camp. I think of it as a currency. So I've got several ways where I can have some degree of comfort. I also have some really smart people joining me in this regard. So I encourage you to think about gold as a hedge in a world that's getting less predictable. So with that, I go to my last chart, and this just may be the statement of the world. It's the sort of thing that keeps me humble. This is a difficult thing to figure out. So act with caution, but don't be so negative that you can't be opportunistic at the right time.
Thank you, Dick.
That's it.
Perfect. Dick mentioned earlier he could spend 30 minutes on each slide, and instead of doing so, delivered a perfect 35-minute, 39-slide speech, for which we are grateful. If anyone wants to type in questions, I know a few have come across already. Now is the time. We have about 10 more minutes. Maybe while they're contemplating questions, Dick, you mentioned the pounds movement this morning. It looks like the jobs number came in at 156 versus an expected 176. How do you feel sort of real time about what the pound movement means and whether there's something broader afoot?
The pound, look, I'm not an expert on a lot of these things, but what the pound movement means to me, there's greater volatility in the system, and it tells me, remember there was a relaxation about Brexit, we can work our way out of it. This tells me it will be a lot more difficult than you think. So it's not a destabilizing force, it's an impact on worldwide growth and profitability. So I need to reflect that.
A question about buyback activity, noting that debt to EBITDA ratios are higher than they have been. Do you see buybacks slowing based on some of your conversations with?
I think that question is being asked somebody I know.
You can see the name.
Yeah. Hi, Jake. I hope things are going well with you. Look, I'm a believer. I was a great advocate 7 or 8 years ago that corporate buybacks were one of the best things that corporations could use their money for. I was not in favor of them borrowing to buy back. But anyway, I would say buybacks should slow. I think corporations should be thinking about their profitability will slow. So think about it in the future. If I had my choice of being a CEO, this is a stage I would repair my balance sheet. Some companies may not have any issues like that. Just simply apply the formula I've always applied. If your stock price is selling at a significant discount to its fair value, buy back stock. If it's not, don't do it. I would argue you would get a better return, you the corporation, if you told the world that we will be growing our dividend over time. Because that's what I most desperately need as an institution.
Great question that paraphrases the title of Howard Marks' book about the most important thing. What is the single most important investing rule that you follow?
I think Howard said the same thing. Don't lose money, right?
Exactly. Do you think, what about to Adrian's question about wage inflation and a possible pressure from wage inflation on profit margins? You mentioned profit margins.
Adrian, the answer is yes. Hopefully the charts describe that. We should be saying that is a risk I have going forward. It's possibly just at the beginning. A different administration in the future, I think, could elevate that to a problem. And the first phase of this, it will be a squeeze on margins because there'll be lesser ability to raise price.
You talked a little bit about gold, Dick. A question that would obviously be situation dependent here about allocations to gold and cash, but what are you seeing in terms of gold and cash allocations, or what do you think is reasonable for a money manager within a given mandate to?
Look, there's some questions you ask that go to a much higher level than I'm capable of doing. So I don't know what a right allocation is. If you want to go to the extreme, there's this guy, who was it, Howard Ricketts or whatever, wrote the book on gold. He said maximum 10%. A lot of people say that's high or low. I don't know. What I'm saying is you have to figure out what is comfortable for you. If you're somebody managing portfolios and you have a benchmark, that's going to affect the way you think about it. But let me tell you how I'm thinking about it today. I am not thinking about benchmarks today. As I said, I'm thinking about protecting money and being opportunistic at the right time. And gold is one of those places where I'm accumulating gold over time. I actually sold some 2 months ago. I will buy it back. Today's the time to be buying it back because it's just, let's call it in simple terms, an uncorrelated asset, and fewer people have options. And I go back to the headline in my handout. Gold is an echo chamber of anxiety. That's going to persist. So why not have some?
What about cash?
George asked the question to me. To me, the right thinking process today, I start with cash. That protects me. I can't lose on cash, I don't think. But wait a minute. In Europe, you can lose on cash. I want cash, and I will act when I have something compelling. I don't care whether I'm 80% invested or 40% invested. The most important thing today is to generate a return and not lose it. At Mayo Capital, one of our top performing accounts has consistently this year been 50% invested. That sounds like an anomaly, right? Simply demanding a higher level of certainty, it had fewer of our mistakes. So that's what so have cash, think strategically, act tactically when given the opportunity, and I think you get an acceptable return.
Good. We think we have time for one more, and there's one here from the pension perspective.
You got a problem.
Which I think you could see, Dick, asking about being mindful of long-term fixed obligations and trying to immunize liabilities in this kind of fixed income environment. How do you think investors should frame decisions relating to meeting obligations in a low return world where you, as you say, you have to earn a return?
Is this Bob?
Yes.
Bob, you've tested me and probably taken me on where I have an adequate answer. You're asking the question we're all asking, and I don't think we have answers yet, and we're struggling to structure portfolios. If you got your actuarial return of 7, I don't know where you go get 7+ in today's world. You struggle. I'd love to have a conversation with a series of people like yourself. What do we do? Where do we go? There should be some place, right? Or you step back and say, let the world change before I definitively answer the question. Sorry for the hesitation, but look, I'm a believer the most important thing I can do is remain true to when you don't know, don't screw things up.
You quote a famous academic on that point just a few weeks ago, right?
George referred to a famous academic who had a chance to participate in a video conference. If I gave the name, you would recognize it. I don't want to violate any privacy, whatever. But probably one of the most intelligent people I've ever had a chance to talk to, when asked these sorts of questions, gave the same answer. I don't know. But don't take that as a cop-out. Take that as you're probably ahead of everybody else by reflecting on that and acting accordingly. Then spend your time figuring out how you can do better.
Perfect. Well, thank you, Dick, on behalf of everyone who had the chance to learn from your thinking here. We appreciate your time, and thanks to everyone who was able to dial in and join us live for the webinar.
I hope it was helpful. Thank you.
Have a good weekend. Thanks.